Official AMA, Alexis Goldstein, Friday, April the 2nd at 11 a.m. EST mod announcement Gorilla Hi all. Official AMA, Alexis Goldstein, Friday, April the 2nd at 11 a.m. EST mod announcement Gorilla Hi all. Alexis Goldstein here. I'll be doing an AMA this Friday the 2nd of April at 11 a.m. EST. A little bit about me: I currently work advocating for a safer and fairer economy. But I started my career on Wall Street. I worked as a programmer at Morgan Stanley in electronic trading, and as a business analyst at Merrill Lynch and Deutsche Bank in equity derivatives. I recently testified before the House Financial Services Committee in their second hearing about GameStop. You can find my written testimony here. I also discussed the GameStop situation on Twitch with AOC back in February. Here is a clip of our discussion. Here are two recent appearances of mine on CNBC and BBC, both discussing GameStop. Questions for reform following the GameStop hearing. Squawk Box, CNBC, why GameStop is Goliath vs Goliath. BBC World News, I write a newsletter about the financial markets called Markets Weekly Unicorn Head. There, I've written about GameStop, over-concentration of Dogecoin, and Archegos. Finally, I wrote a bit about the broader implications of GameStop in an op for the NY Times, where I argued that we can't beat Wall Street at its own zero-sum game. But we can change the rules. I believe that truly democratizing the economy means pouring national resources into lifting up Americans and rebuilding public institutions. That looks like canceling federal student debt, which President Biden can through executive action, would grow the economy, relieve the disproportionate debt burdens carried by black and brown borrowers. It could also mean examining policy changes like a modest wealth tax, a financial transaction tax, and creating programs like baby bonds to fight the racial wealth gap. Finally, I believe that regulators need to make sure that non-banks like asset managers and hedge funds aren't taking advantage of regulatory blind spots to make themselves too big, or too interconnected to fail. Thanks for hosting me. Unicorn Head. Written testimony of Alexis Goldstein, Senior Policy Analyst, Americans for Financial Reform before the United States House Financial Services Committee. GameStop. Who wins and loses when short sellers, social media, and retail investors collide? Part 2, the 17th of March, 2021, 10 a.m. Chairwoman Waters, Ranking Member McHenry, and members of the committee, thank you for inviting me to testify at this hearing. My name is Alexis Goldstein and I am Senior Policy Analyst at Americans for Financial Reform, where my work focuses on financial regulation and consumer protection. Before working at Americans for Financial Reform, I worked as a programmer at Morgan Stanley in electronic trading, and as a business analyst at Merrill Lynch and Deutsche Bank in equity derivatives. There, I worked primarily as a product manager for the trading and risk management software used by the global equity options flow trading desks. I want to start by thanking Chairwoman Waters for her leadership in convening the very first congressional exploration of the issues raised by volatility in GameStop equities. I am encouraged that the committee is continuing to dig into the larger questions the GameStop phenomenon raises. Many have framed the GameStop mania as a David versus Goliath struggle. I believe it is more likely that, when we have full information about this episode, the story will more closely resemble Goliath versus Goliath. The Goliaths in this case are the largest Wall Street institutional players, hedge funds, especially those that employ high-frequency trading algorithms, and the flow trading desks at major banks like Goldman Sachs and Morgan Stanley. Retail traders driven by the Wall Street Bets subreddit and the exuberance that ensued may end up losing big, notwithstanding the squeeze they put on some institutional players. These large institutional players have structural advantages over retail traders: superior data, sophisticated, high-frequency trading software, and access to trading venues not available to retail traders. These include dark pools, private exchanges where they send large orders quietly to avoid moving the market against the trade, and over-the-counter markets, where they trade with one another rather than on public exchanges. These advantages mean that GameStop's 1,700% price run was not the end of Wall Street's dominance. In fact, it may also be a source of major Q1 2021 profits at large banks with flow trading desks. When I worked at Merrill Lynch from 2007 to 2009, its equity derivatives trading desks took in the biggest profits on the most volatile days. That's because they are mostly agnostic to price movements, rather they essentially make money on volume and market churn rather than the traditional ways that retail investors make money, by buying low, holding and selling high. My time on Wall Street also showed me that major institutional players guard information about their own positions, while simultaneously spending large sums of time and resources trying to glean the positions of their competitors, whether through market data, news stories, or rumors. Thousands of users of the Wall Street Bets subreddit posting their positions and their future plans for those positions is a source of data that major Wall Street players will mine for information. Many will likely have created software to extract and analyze the content of the posts, and made trading decisions based on it. For it's understandable, however, why a narrative of David versus Goliath emerged at this moment. Wall Street profits soared during the pandemic, while Main Street endures intense and prolonged suffering, a phenomenon that economists have deemed the K-shaped recovery. In November 2020, 10.7 million workers were officially unemployed, but the Economic Policy Institute estimates the real number of unemployed Americans is closer to 26 million. 6 a.m. disproportionate burden of the impact of the pandemic falls on Black and Brown Americans. Latinx Americans have faced large losses in employment. 7 Black workers are more likely than other workers to be in frontline jobs, 8 but are less likely to be rehired if they lost their jobs. White workers are getting hired back twice as fast as Black workers. 9 Given the extreme imbalances in the economy right now, it makes sense that the media and the public would be drawn to a story of the little guy taking down a large, moneyed speculator. The GameStop issue shines a spotlight on issues in the market that long predate this incident. To begin to address them, regulators and lawmakers alike should examine the footprint of large institutional players in the GameStop phenomenon, investigate if large hedge funds are creating undue risks in regulatory blind spots, improve trading disclosures by hedge funds, scrutinize the payment for order flow model, and consider changes to capital requirements at brokerages. Doing so would make the markets fairer and more transparent, better protect retail investors, and help to curb insider advantages. Regulators should examine the institutional footprint during GameStop's volatile periods. While retail traders have traditionally been a small portion of the market, and thus often ignored by larger institutions, their numbers have shown dramatic growth in the last few years, especially during the pandemic as more and more individuals are unable to leave their homes. Credit Suisse estimates that retail trading has doubled to 30% of the overall market since the beginning of 2020. But even with retail trading volumes at record levels, they are still less than 1/3 of the overall market. Questions remain about the roles the Goliaths of Wall Street, the hedge funds and the flow trading desks of major investment banks, played in the GameStop price dislocation. 11 As Bloomberg's Matt Levine speculated, much of the move in GameStop's price may not have been caused by retail traders on Robinhood and Reddit, but by professionals, hedge funds and proprietary trading firms and professional day trading shops. 12 major Wall Street institutions may choose to trade equity options over the counter, when large broker-dealers trade bespoke options with each other, instead of through the standardized options available on exchanges. 13 But Wall Street firms typically still hedge their positions by buying or selling listed stock. Hedging is a way to minimize the risk of large losses by trading an offsetting position. While doing so limits profits, it also limits losses. When trading options, many Wall Street flow trading desks employ a technique known as delta hedging, where options traders try to insulate their portfolio's value from moves up or down in the price of the stock. They do so by purchasing or selling stock against the options they trade. 14 Having a sense of the volume of over-the-counter options trades in meme stocks like GameStop, Nokia, BlackBerry, COS, and AMC from the 21st of January, 2021. The 4th of February, 2021 would provide a bit of a window into the role large institutions played in GameStop's volatile run up and down in price. Thus, regulators should examine the trading volumes that institutional players made in over-the-counter equity options markets and dark pools, which are venues unavailable to retail traders, during the period of extreme volatility in GameStop trading. In addition, lawmakers should evaluate if there are data gaps or points of friction in current reporting regimes, and if so, work to bring more transparency and speed of reporting to over-the-counter options. The SEC should also work to finalize the Consolidated Audit Trail, first proposed after the 2010 flash crash, where in just 10 minutes, the Dow Jones Industrial Average Index lost 1,000 points, nearly 9% of its value, only to recover shortly thereafter 15, and now long delayed. 16 A growing dominance of wholesalers in retail trading. As retail trading has become more popular, a large amount of their trades now execute in venues other than the stock exchanges. Rather than sending a client's order directly to an exchange, market makers, also known as wholesalers, like Citadel Securities, can match an order against either its own inventory, or against other orders. This is a process known as internalizing. 17 A visualization of internalization by market makers by the Securities and Exchange Commission. 18. If you combine the trade executions of Citadel Securities and Virtu Financial, two major market makers for retail trades, they execute a larger volume of U.S. stocks than the New York Stock Exchange. 19 Citadel Securities is especially significant in listed equities, which include both stocks and exchange-listed equity options. Its website proclaims that it executes approximately 47% of all U.S. listed retail volume each day. 20 This means nearly half of retail equities trading is happening in a venue with less transparency. 21 By contrast, lit exchanges like NYSE or Nasdaq publish quotes that allow everyone to see the available liquidity in a given equity product. 22 As Professor Gina Gale S. Fletcher noted in written testimony to the Senate Banking Committee, orders that execute off exchange are not contributing to price discovery, and with so many retail orders trading through wholesalers, retail trades become inaccessible sources of liquidity. At a minimum, policymakers and regulators should evaluate if there are either data gaps or time lags in the reporting of off-exchange trades. But regulators should also examine the impact of the growth of off-exchange trading on price discovery writ large. Before Citadel Securities dominated the retail market, it set about in 2008 to build an investment bank to rival the likes of Goldman Sachs. 23 At least one analyst pointed to the fact that, as a hedge fund, Citadel was less regulated, giving it an edge over the U.S. investment banks overseen by the Federal Reserve. An unregulated company coming into this sector has a real good shot. Richard Bove, a financial services analyst at Rochdale Securities in Lutz, Florida, said in 2010. 24 Despite its efforts, Citadel was ultimately unable to break into investment banking, and decided to refocus on electronic trading and market making. 25 But Citadel's regulatory advantages have persisted. Unlike the major U.S. banks, Citadel is neither supervised by the Fed, nor has it been designated a systemically important financial institution, SIFI. Thus, no regulator is looking holistically at risks across all of Citadel's firms. Changing its focus to electronic trading and retail investors appears to have paid off for Citadel. A decade after abandoning its plans to compete in investment banking, Citadel's hedge fund has $33 billion in investment capital as of January 2021. Ken Griffin, Citadel's CEO, owns 85% of Citadel Securities, which had record revenues of $6.7 billion in 2020. From the 25th of January, the 28th of January, Citadel Securities executed around 30% of GameStop shares. 26 In written testimony, Griffin boasted that when others were unable or unwilling to handle the heavy volumes, Citadel was there, executing 7.4 billion shares on behalf of retail investors on January 27, which is more shares for retail investors than the average daily volume of the entire U.S. equities market in 2019. 27 regulators, including the Financial Stability Oversight Council, FSOC, may want to consider investigating whether Citadel Securities' outsized presence in retail market making raises concerns about liquidity risk, counterparty risk, and interconnectedness, and thus, may be an emerging overall risk to U.S. financial stability. 28 The FSOC should also revive the Interagency Hedge Fund Working Group that was eliminated by the Trump administration. Regulators should consider increased transparency in 13F reporting. Another issue the GameStop situation has highlighted is the lack of transparency into hedge funds' positions. The SEC requires institutional investment managers that exercise investment discretion over $100 million or more of certain equity securities to file a 13F report with the SEC. 29 However, disclosures are quarterly, and lack disclosure of short stock. The SEC should consider amending the disclosures required by Form 13F to include short stock positions. The Commission should also consider reducing the reporting threshold, 30, and reducing the lag between the date triggering Form 13F disclosure and the required filing date, as some have suggested. 31 Payment for order flow, Robinhood, and best execution. It is important for regulators and lawmakers to consider how to make the true costs of trading more transparent. Payment for order flow, FOF, an arrangement where a market maker pays a retail brokerage a preset fee for every trade they execute, obscures this cost in many ways. In 2016, the SEC wrote a memo to its Equity Market Structure Advisory Committee, asking a series of questions about FOF. The Commission pointed out that FOF can create potential conflicts with a broker's duty of best execution. Best execution is a legal mandate that requires brokers get the most advantageous order execution for their customers. 32 Brokers must conduct regular and rigorous reviews of its execution quality against competitors to evaluate if it's obtaining the best terms reasonably available for customer orders. 33 The SEC's concerns about FOF's potential conflict with best execution now seem prescient. Both the wholesalers most used by Robinhood, and Robinhood itself, have already faced regulatory enforcement actions for past failures on best execution and other issues. In December 2020, the SEC charged Robinhood with failing to disclose that it was using this payment for order flow model at all. The SEC also found that Robinhood was failing to provide best execution to its clients, thus costing them over $34 million due to inferior trade prices even when factoring in zero commission trading. 34 FINRA fined Robinhood in 2019 for best execution violations related to its customers' equity orders and related supervisory failures. Robinhood paid a $1.25 million fine. 35 In 2017, Citadel paid a $22.6 million fine to settle charges with the SEC over misleading statements to them about the way it priced trades. 36 in 2020, Citadel was fined by FINRA for trading ahead of clients. 37 in 2019, Virtu Financial settled with the SEC over violations of Regulation SCI. 38 in the Commission's 2016 memo, it also noted that without FOF, market makers could have incentives to quote more competitively, leading to better prices for their customers. The SEC suggested that if FOF were prohibited, market makers might need to lean harder on the competitiveness of their quotes in order to gain the business of brokers. 39 without FOF, we also might see a smaller portion of retail trades being executed off exchange, and instead trading more on the lit markets like NYSE and Nasdaq. With more volumes on lit exchanges, we might see tighter spreads. A spread is the difference between the price participants are willing to buy and sell at. The SEC outlined a series of potential steps that could address the issues raised by FOF, including an outright prohibition, as exists in Canada 40 and the United Kingdom 41, or requiring brokers to pass any payment for order flow back to its customers. In the first House Financial Services Committee hearing on GameStop, Robinhood CEO Vlad Tenev was asked if he would voluntarily agree to pass payments for order flow on to Robinhood's customers. 42 He declined, saying that it would end commission-free trading. His hesitance may be rooted in the fact that from 2015 mid-2016, a staggering 80% of Robinhood's revenue came from FOF. 43 While many other retail brokerages also take FOF, Robinhood competitor Public decided to end its participation in FOF in February. 44 While Fidelity has long declined to take FOF on stock trades. 45, though it does on options. 46. Both brokerages offer commission-free trades. Robinhood has simultaneously argued that the FOF amounts are low, an average of $0.0023 per equity share. 47 If that's the case, it seems reasonable to expect that, should Robinhood's revenue stream of FOF end, the commissions it charges to clients would also be in the $0.0023 per equity share range. T+2, T+1, T+0, real-time settlement, and broker capital requirements. Robinhood tried to blame the freeze it placed on purchases of GameStop and other volatile names by their customers on a number of factors, including clearinghouse capital requirements. 48 and the two-day trade settlement period, T+2. But it is unclear if Robinhood's singular focus on clearinghouse requirements and a lack of real-time settlement may be an attempt to explain away what may have been internal risk failures, namely the inability to predict needed backstops to guard the firm against failure, which led to Robinhood needing to raise some $3.4 billion in a matter of days. 49 While there are many reasons to consider moving to T+1 settlement, challenges remain that make moving to T+0, or even real-time settlement, difficult at this time. As one example, T+0 would eliminate flexibility some market participants rely on 50, and prohibit netting, which allows transactions to be netted together even if the trades execute over tens, or hundreds, or thousands of separate orders. As the Depository Trust and Clearing Corporation, DTCC, wrote, allowing trades to net settle reduces the total amount of cash and securities that have to go back and forth throughout the day, and eliminates a significant amount of operational and market risk. 51 Losing the benefit of netting would create significant new operational costs. Rather than pushing to move to T+0 or real-time settlement before the industry has even made it to T+1, Congress and the regulators should instead examine if broker capital standards as they are today are adequate to withstand periods of extreme market stress. 52 Conclusion In the wake of the 2008 crisis, research showed that while casino gambling went down, playing small-dollar lottery games with big jackpots increased among those who continued to struggle financially through the recession. 53 Reddit and Robinhood are driving a new kind of financial lottery, trading cheap options that require giant price moves to become profitable. Robinhood is certainly trying to encourage this, using targeted advertising on social media, with a tweet declaring millions of people will soon begin receiving stimulus checks 54 and links to a blog post that says at Robinhood we think a missed opportunity is waiting too long to start investing, or worse, never investing at all. 55. But those who tend to make the most during these bubbles are the already wealthy. 57. Capital markets should be reformed to be fairer for retail investors, and to curb the abuse of insider advantages. The way to truly democratize the economy is to curb the drive to speculation by pouring national resources into lifting up Americans and rebuilding public institutions. Canceling federal student debt, 58, which President Biden can do without Congress. 59. Would grow the economy. 60. Relieve the disproportionate debt burdens carried by black and brown borrowers. 61. And incentivize science and engineering graduates to consider careers benefiting the public good, rather than just building the best math formula that can earn a big Wall Street firm a few more fractions of a cent on a stock trade. A modest wealth tax could be redirected to priorities like universal childcare or tuition-free higher education. Lawmakers should ensure hedge funds aren't taking advantage of regulatory blind spots to make themselves too big to fail. A very small financial transaction tax could fund investments in reducing the racial wealth gap through programs like baby bonds. 62. Trying to mimic this with zero-sum policies that seek to supposedly democratize access to financial markets and disrupt old ways of thinking helped get us into this mess. But bold investments in public institutions can get us out.
With all of the potential activity, and please correct me if I'm wrong, but in a way, are you saying that you have all of these Wall Street actors that are seeing what's going on potentially with this online activity and saying, well, we know that there's going to be a high volume of buys ahead of time, so I'm also going to buy under kind of the guise of all of this online activity going on, and then potentially make out on top of it as well.
Yes.
That's what you're saying too? So
yes, that is my suspicion, yes.
So yeah, so you suspect that this is not just Redditors buying this stock, but that it's also potentially larger actors on the market, and that's something to explore, that this is potentially larger actors on the market looking at activity happening ahead of time and then getting ahead of it that as well, and almost using that as a veneer for riding this stock.
Yeah. And there's one other wrinkle to all of this that I think is important for folks to know, which is a lot of folks have used the app Robinhood, which I like to think of as the Facebook of stock trading. And I say that because Facebook is sort of designed to keep you on Facebook, right? It's designed to grab your attention and keep your attention. And Robinhood is very similar. I would describe it as gamified. I know a lot of Robinhood folks would disagree with that assessment. That's just my personal assessment. But Robinhood is free. It doesn't charge commission. And the way that their business model works is they sell their order flow to market makers, which are these sophisticated Wall Street participants who execute the orders for them. The market maker they sell the most of their flow to is a hedge fund named Citadel. And Citadel is not just a hedge fund. They are also a market maker. They are also a technology company. They are owned by a billionaire named Ken Griffin, who is out of Chicago, who has funded some very questionable things in his political giving. But Citadel pays for Robinhood's order flow. And strangely enough, or maybe not so strangely, one of the hedge funds that Wall Street Bets was very excited about blowing up, Melvin Capital, was rescued by Citadel after it blew up. So Citadel is paying for the order flow on Robinhood, which is driving up the price of the stock, which crashed one hedge fund. And then Citadel sort of bought that hedge fund on the cheap after it crashed.
And so, for folks at home, so that we can put these dots together, because I think this is an important relationship for us to communicate and map out with you. So basically, also what you're saying now is that you've got Melvin Capital, right? Melvin Capital is the hedge fund that was shorting GameStop. They were the folks that were saying, we're going to make a ton of money. We're going to make a ton of money off of GameStop's stock going down. Wall Street Bets comes in, potentially with folks on Wall Street looking at what Wall Street Bets is doing to kind of supercharge this activity and say, you know what, we're going to make the stock go up, which would, of course, put Melvin Capital into an extraordinarily compromised position, which would essentially prompt them to get bailed out by one of the groups known as Citadel. Now, okay, so Citadel then swoops in as one of the actors to bail out Melvin Capital, but Citadel's owner also co-founded a different Citadel. They're both connected, hence the same name by the same owner. They are two technically different entities, though, but they are the same founder.
Right. So Citadel LLC is the parent company. Citadel Securities is the market maker that buys the Robinhood order flow. But the parent entity, Citadel LLC, is the one that swooped up Melvin Capital. And Congresswoman, I should just add there were actually two Wall Street firms that bought Melvin Capital, or rescued it, I should say. Citadel and another one, now I'm blanking, of course, on the name, but it's the new fund of Steve Cohen, who you may know as the owner of the New York Mets. And Steve Cohen is famous for all the wrong reasons.
Is what the chat says.
Yes, thank you. Steve Cohen is famous, or infamous, I should say, because he used to have a hedge fund called SAC that pled guilty to insider trading in 2013 and had to shut itself down. And so this is the next iteration of Steve Cohen.
Right. So we've got Citadel and then Point 72, who bail out Melvin Capital, who are relying on GameStop stock to tank. So Citadel swoops in to bail out Melvin Capital. But then meanwhile, this connected Citadel under the same founder, it also receives the advanced information from Robinhood. That's what you're saying?
Yes, and I should clarify that's not unusual. That is allowed. It is something called payment for order flow. During the Obama administration, they raised the question about whether or not that was a good idea. They asked one of their SEC, which is a market regulator, they asked the SEC's advisory committee if payment for order flow was just kind of disguising how you were really paying for stock trading. So the idea is Robinhood is free, you don't pay commission, but the broker is supposed to make sure that they give you what's called best execution. So they execute your trade and either get you the best price or they execute it really, really fast. Citadel is paying Robinhood for that order flow, and they pay them via these things called rebates. And Citadel might pay, whatever they pay. A different market maker may pay a little bit higher rate. And what is not supposed to happen is the broker is not supposed to give the order flow to the highest bidder, because that would prevent them from giving their customers best execution. People should know that Robinhood was accused by the SEC in December of 2020 of not giving their customers best execution and actually costing them $34 million. Even when you accounted for the free commissions, because of their failures to provide them with best execution.
So you're saying just a month ago, Robinhood was in trouble for not optimizing their customers' trades?
Yes, it was covering a period of time farther back in time, right? It was, I think, in the 2018 range, but the action came down. Robinhood did not admit nor deny guilt in the action, but they did have to pay a civil penalty to the SEC to settle the charges.
And they did pay that penalty to the SEC. So these were charges that came up from the SEC just 1 month ago, but these were they were regarding actions that happened in 2018, but that this is documented past behavior from Robinhood.
Correct. And the other thing is Robinhood wasn't disclosing, another part of that action was Robinhood wasn't disclosing that they were paying our market maker for the order flow. So why do I bring all this up? I bring this all up to say, is Robinhood doing the best by their customers? Are these fintech companies that are so easy to use that lots of people are using to trade stocks, are they doing right by their customers? I think that's an important question that regulators should be asking right now.
So let's talk a little bit about what happened today with the freeze that you saw, not just on Robinhood, but on, I believe, E-Trade, Wellbull, etc., where you have a lot of these retail, these retail platforms, all of a sudden putting a halt to some trades on not just GameStop, but there's also some activity, I believe, around AMC and other stocks that have been particularly identified by the subreddit Wall Street Bets. Tell me a little bit about what is going through your head when you see activity like that. And, for folks at home, there are multiple possibilities here. I think a lot of people sometimes want to jump to certain conclusions, but in order for us to really responsibly look at the situation, it does seem like there's more than one potential explanation. But I'm interested in hearing what's going through your head when you see that, and what are some of the possibilities that could arise?
So I just don't know why Robinhood made the decisions they did to stop trading, allowing purchases of certain single name stocks today. Their decision was a little different than some of the other brokerages. So for example, so think of it from the point of view of the brokerage, right? Especially if people are selling stocks short, which has the potential for unlimited losses. If your client goes bust and enough of your clients goes bust, then the brokerage goes bust. Mm-hmm. So what a different brokerage did, not Robinhood, but one called Interactive Brokers and some other brokers on the that regular people use, is they just changed what's called their margin requirements. So if you wanted to buy a stock in some of these really active, volatile names today, you had to supply 100% cash margin. And what does that mean? You basically just had to front all of the money yourself, which might sound funny to people who don't trade stocks, but believe it or not, you can sometimes trade stocks with borrowed money. So they were basically saying you can't borrow any money. You got to trade cold hard cash if you want to buy these stocks. So that's what I sort of would have expected to see from everybody. Instead, what we saw is Robinhood just straight up saying you can't trade in any of these names. Now, I don't know that we know any more than that. Was there, direction coming in from regulators? Was this just a decision made by Robinhood? I don't think we know, but I was a little surprised at their action as it related to what other brokers did. And I should just say, if we can just rewind very slightly, because I forgot to mention this before about the whole idea of payment for order flow. The reason that's important is because the firm that you give your order flow to knows what your executions are, and they can run in front of it and front run and trade ahead of it and make profits, which may be fine or may not be fine. But I just thought that that's important to mention.
So you're saying,
Citadel.
Sorry, you're just about to say, and Citadel's the one who receives that advanced
Correct.
Information from Robinhood. So
Correct.
all of these folks, but that advanced information only lasts for a few seconds, right?
Correct, but Citadel is known, and other entities that do this market making are known for their high frequency trading algorithms. That's their specialty. Mm-hmm. They're experts. They hire tons and tons of programmers, and so they're allowed to make profit ahead of that. Mm-hmm. But I think the question that a lot of people have, and we just don't have enough information to know, is were they doing more with that information than just executing the trades?
And so those are some of the questions that seem to be outstanding, right? Because if Citadel's receiving this advanced trade information from Robinhood, I go on my phone, except not me, because I don't believe members of Congress should own individual stocks, so I don't have any. But hypothetically, if I'm on Robinhood and I hit my order along with thousands of other people at that moment, Citadel is potentially able to get that information milliseconds in advance. And in those milliseconds, their trading algorithms could adjust, knowing that advanced execution information. Is that correct?
Yes. And I'll say that since a lot of the Robinhood trades are very low volumes, what they often do is batch them together. And so Citadel might be trading in much larger volumes and then matching the orders as they batch them together. Again, all in this sort of time of many microseconds, but that's what they specialize in doing, is this very, very high speed, high frequency trading, as it's called.
And so I think here, for folks that are watching at home, this is what raises a bunch of questions, not just from me, but also from, I think, this is why this is starting to attract the attention of regulators, members of Congress, et cetera, because there's a lot of policy questions that come up. Policy questions about shorting stock, policy questions about, as you said, some of this advanced information. You mentioned the Obama administration started to raise some questions about the potential for this. And I think this also is about power, right? Because everyday retail investors don't get that. Even if you were able to, who knows, program something at home, you do not have that millisecond advance information. You just don't have the market power to have that, right?
Right. And I think that's the reason why, yes, lots of people are making money right now. Yes, one or two hedge funds are blowing up, but there's still always going to be a systemic disadvantage that retail has. And that Wall Street is always going to have the advantage. They have more data. As you said, Congresswoman, they're faster. They can execute things faster. And so they're always going to run circles around the little guy, even if it seems like they're losing.
Today, lawmakers finally get a chance to grill some key players in the recent GameStop trading frenzy. Our next guest says that the short squeeze drama that played out was not one of David versus Goliath, but really one of Goliath versus Goliath. She's going to explain that to us in just a moment. She was a guest on Democratic Representative Alexandria Ocasio-Cortez's live Twitch stream last month and talked about this very issue. Joining us right now is Alexis Goldstein. She's a former Wall Street professional who now works as a senior policy analyst at Americans for Financial Reform. Alexis writes about the financial markets in her newsletter, Markets Weekly. And Alexis, it's good to have you here. Thanks for joining us.
Good morning, Becky. Thanks for having me.
Let's talk a little bit more about your background, because I think that's an important thing that people need to understand on how your opinions have been formed on this. You're a computer programmer, and you worked at a lot of the big Wall Street firms, including Morgan Stanley. What did you do there?
So I was a programmer at Morgan Stanley. We developed a software platform we gave away to hedge funds for free in order to try to solicit their order flow. Then later on, I moved to Merrill Lynch, where I became a business analyst and was the interface between the equity derivatives flow trading desk and the technology team, helping build their internal risk management software and their trading platforms. And then I did the same thing at Deutsche Bank.
So let's talk about first your time at Morgan Stanley, where they were building this this program that they would give away to free for the hedge funds. Why? Nothing's ever free. Why would you give this away to hedge funds for free?
So you can think about it, it's in some ways similar to the Robinhood situation, right? The flow of institutional players, of retail players is very profitable for firms that execute lots and lots of volumes of trades, because it's a volume business. And if you are able to get better execution than your competitors, which I think Morgan Stanley was confident that it was able to do with their sophisticated software and, very fast speeds and various trading algorithms, we could make money off of the volumes of institutional players. And that included hedge funds. And so we wanted to solicit more of their trades to come to us than, say, our competitor, Goldman Sachs.
When you say that you think this is a Goliath versus Goliath situation, what do you mean? You don't think that these were retail investors on the other end of the trade?
So I think Wall Street guards its positions ferociously, right? They don't want you to know what their position is, but they spend a lot of money to try and figure out what their competitors' positions are. And here we had tens of thousands of retail traders posting on the internet not only what their positions were, but what their plans for their positions were in the future. And I think it's highly unlikely that that kind of data would be unused by large Wall Street Goliaths. I think it's probably likely that hedge funds and other major players were watching what the plans of these retail traders were and trying to figure out how they could profit from it and probably ride the stock all the way up and then ride the stock all the way down. Because look, at the end of the day, the traders that I used to work with at Merrill Lynch and Deutsche Bank, they had their best days when there was extreme volatility and huge price movements. And if I were to make a guess, and I don't have a crystal ball, I think the first quarter earnings for a lot of these large Wall Street firms that have the kinds of flow trading desks in options and equity options like I used to work on are probably going to have a really good quarter because of this volatility.
It's complicated stuff. Washington's going to dig in today, and complicated stuff like this is not always something that's easily discerned through one of these hearings where people have a set number of minutes that they can talk, and a lot of them are trying to grandstand and make attention and get names for themselves. What advice would you give to these lawmakers if they are serious about trying to reform this? What would you tell them?
Well, I think that this is an issue that has the potential to bring a lot of attention to sort of an underregulated market, which includes hedge funds, right, which are regulated, but they are less regulated than the large major banks. And so I think questions that will sort of bring out some transparency into the practices of, say, Citadel LLC, or to the extent that they want to talk to Melvin Capital. I'm not sure you're going to get too many questions directed at Melvin Capital today. I think this is a good opportunity for Congress to sort of set the agenda of how they want to respond to this and ask the question, do we need more regulation? Do we need more transparency? Do we need changes to the kinds of things hedge funds are reporting? And do we need changes to the over-the-counter markets? Because let's not forget, there's a whole marketplace that is not available to retail traders, which is the over-the-counter options market. And I think the regulators are probably going to be asking questions about what were the volumes of options trading in these over-the-counter markets that are totally inaccessible to retail investors. And I think you might see some questions today from Congress about that.
Alexis, we're about out of time, but if you had to pick one thing that struck you as the weirdest practice on Wall Street that didn't make a whole lot of sense, what would it be?
They would try to guess which of their interdealer brokers were in violation of the rules about gifts. So they would often get like bottles of champagne at the end of the year, and you could only give them a gift that was worth $100. And at sort of on a slow day, they would Google it and see who cheated and who broke the rules. And if they found out somebody cheated, they were sort of like, good job, well done. So that was one of the weirder things I thought.
Alexis, we'd love to have you back. I think you have lots of insight about what's happening, and we're going to be following this pretty closely. But thanks for your time today. It's good talking to you.
She used to work on Wall Street. She's now a senior policy analyst with Americans for Financial Reform. Good to talk to you. This is characterized sometimes as a sort of David and Goliath battle. Is it really?
I actually think that what's happening is this is a Goliath versus Goliath battle with David as a little bit of a distraction. So one of the things I learned when I was working on Wall Street before the last and during the last financial crisis is they made the most profits typically on days that had a lot of churn and a lot of price movement. And while I do think that the sort of initial idea to buy stocks like GameStop and some of these other active names may have initially started on a Reddit forum, Wall Street's dream is to know the positions of their competitors, and they try to hide their own position from their competitors. And now you have tens of thousands of people openly posting about not only what their positions are, but what their plans for those positions are. And so what I suspect, right, I don't have enough data to know, but I suspect that Wall Street was sort of going along for the ride and sort of exacerbating and also inflating some of these prices up. And at the end of the day, I think if I were to make a guess, Wall Street is probably going to have an extremely profitable first quarter simply as a result of all of these volumes. And so that's why I think the David versus Goliath narrative might not be exactly what's happening here.
So actually the professionals make money from volatility. In a way, the house always wins.
That's right. It sort of doesn't matter. They're price agnostic, right? As long as there's churn, they have these sophisticated algorithms and price risk management software. And so as long as they're hedging their bets and that's their job, they basically make money regardless of if the price goes up or down. Yes.
I mean, clearly some of the Reddit investors are very sharp and some are making big money. You don't expect that to go on then? It would be naive to think that the professionals are not on social media as well.
It's very likely that some professionals may be posting on social media. I mean, I think that may raise some investigations for them as a registered investment or financial professional. And certainly there are absolutely people on Reddit making lots and lots of money. But I think the sort of bigger question here, right, to your earlier segment, the United States has had a terribly atrocious response to the coronavirus. And we are sort of jostling right now to see an economic package come through. Just because there's more people hitting a jackpot at the casino doesn't mean the house isn't winning still. still. I think people are sort of drawn in by this narrative in the media because a lot of people are hurting, a lot of people are having trouble making rent. And I think the real solution to this speculative mania here in the United States is policies that make sure that people's basic needs are being met. And that's what's trying to be ironed out in Congress right now, but it just couldn't happen any faster.
Do you think it will happen?
I sincerely hope so, whether it is through some sort of grand bargain. I think they might have to go through what's called reconciliation, which would allow them to just get a simple majority vote. And there's a lot, quite frankly, that they can do with executive actions, too. So I do think that they will eventually get there. I just hope they get there sooner than perhaps they might actually arrive there.
Alexis, thank you very much. Really interesting to talk to you.
Thank you for having me.
Thanks to you for being with us. Stay with us.
What happened with Archegos Capital? Last week, Viacom CBS lost half its value. But Viacom's woes turned into a $33 billion fire sale thanks to Archegos Capital, total return swaps, and leverage. Alexis Goldstein. Read more posts by this author. Alexis Goldstein, the 31st of March, 2021. 6min. Read last week, Viacom CBS positively tanked, losing half its value in more than a week. But Viacom's woes turned into a $33 billion market-wide asset liquidation event thanks to the holdings of a family fund, Archegos Capital, run by Sung Kook, Bill Hwang. Viacom CBS lost more than half of its value from the 22nd of March. The 29th of March, 2021. Why the troubles at Archegos led to market-wide fire sales is due to a combination of things. What Archegos was trading, derivatives that mimic stocks, called total return swaps, and the leverage Archegos employed in doing these trades, who Archegos was trading with, a number of large banks, the lack of disclosures. Many banks were on the same side of the same trade, which exacerbated the fire sale. But that fact appeared largely unknown till it all went bust. What was Archegos Capital doing? Reporting indicates that Archegos' long positions were concentrated in about 8 names: Viacom CBS, Viac, Discovery Incorporated, Disca, Tencent Music Entertainment Group, TME, GSX Techadu Incorporated, GSX, Baidu Incorporated, Bidu, Farfetch Limited, FTCH, EGI Incorporated, IQ, Vipshop Holdings Limited, VIPs, but Archegos wasn't buying stocks in these companies. Instead, perhaps in order to avoid the kinds of disclosures that are required when you hold a certain amount of stocks, Archegos used derivatives that mimic the performance of stocks, but don't have the same disclosure requirements. One of the derivatives they used are called total return swaps, TRS, also known as an equity swap. Sidebar: what is a total return swap, TRS? You can think of a TRS as a financial product that provides nearly the same economic payoffs as a stock, but it isn't a stock, it's a swap. Swaps are financial instruments where two parties swap payments. You can read more about swaps here. In a total return swap, one party makes payments based on the return of an underlying reference asset. The other party makes payments based on a preset rate. This arrangement allows the receiving party to receive all the economic benefits of a reference asset, like a stock's income and capital gains, without actually owning the asset. Illustration of a hypothetical total return swap on Viacom between an investment bank and a private fund. Why might you do this? One might do it to try and avoid taxes of owning the stock outright. You might do it to gain access to a stock in a country that you have to live in to purchase. Or, you might do it, as it seems our Chegos may have done, to avoid disclosing what you own to the public. But this arrangement creates credit risks for the TRS pair. And that risk broke wide open last week for our Chegos counterparties, which included a number of major banks. Unicorn Head. This is a free post from Markets Weekly, a newsletter by former Wall Street professional Alexis Goldstein. If you appreciated this post, please consider signing up here for premium access to all posts. Unicorn Head. Who was Archegos trading with? Archegos had what's called a prime broker relationship with a number of major banks, including Goldman Sachs, Morgan Stanley, Credit Suisse, UBS and Nomura. Sidebar: what's a prime broker? Large banks offer a number of bundled services to hedge funds and large private funds through an offering called prime brokerage. These services can include borrowing securities, via securities lending, executing trades, including trades that use leverage, and cash management. If you'd like a concrete example, here's a PDF from Morgan Stanley marking their prime brokerage offering. Viacom CBS started tanking, leading to a margin call. Reporting has shown that Archegos held total return swaps on the 8 stocks listed above with all of its prime brokers. In order to manage their risk, the banks demand collateral to demonstrate that Archegos wouldn't go under should their trade move against them. When Viacom CBS shares started tanking, one or more of Archegos' prime brokers hit them with a margin call which they couldn't meet. Sidebar: what's a margin call? When a position begins to move against you, your broker will typically demand that you deposit additional money or assets into your account, enough that the value of your account reaches a certain value, known as the maintenance margin. This is a margin call. A $33 billion fire sale. When Archegos failed to meet its margin call, the banks with trading relationships with Archegos needed to begin to unwind the massive positions. But since they all needed to sell shares of the same 8 stocks, there was no way to do it without moving the market. And move the market they did. Here's the daily charts of just 4 of the stocks, Baidu, Viac, TME, GSX, that Archegos had derivative positions in, over the last week, via Interactive Brokers. Archegos counterparties, once they had a handle on what was happening, actually met to try and figure out how they could all offload giant blocks of the same stocks in a way that would disrupt the market the least. The Financial Times reported, before the troubles at the family office burst into public view at the end of the week, representatives from its trading partners Goldman Sachs, Morgan Stanley, Credit Suisse, UBS and Nomura held a meeting with Archegos to discuss an orderly wind down of troubled trades. But it seems Morgan Stanley and Goldman Sachs moved first, perhaps trying to sell before the other banks did, and stem their losses as the market began to move against the names they all needed to offload. It was like a game of chicken, one person said. By Friday morning, any hopes of coordination had been snuffed out and the floodgates opened when Goldman began pitching global investors on billions of dollars of Archegos-linked stocks. Morgan Stanley joined hours later, and the two sold roughly $19 billion in big block trades that day alone, according to the People. Further details from the Foot. People familiar with the talks said Goldman Sachs, which was very exposed to Archegos, listened to the discussions but did not commit to an agreement on Thursday evening. On Friday morning, the bank pitched a $3.6 billion block sale that was quickly increased to $6.6 billion. By the end of the day, the bank had liquidated some $10.5 billion of securities linked to Archegos, according to People briefed on the matter. Morgan Stanley has also sold more than $10 billion worth of stock tied to Archegos, including roughly $8 billion it marketed in big block trades on Friday. Why were so many prime brokers doing business with someone banned from Hong Kong's trading markets? Prior to launching Archegos Capital, Huang pleaded guilty to wire fraud charges in 2012, and paid $44 million to settled insider trading charges with the SEC that same year. 2 years later, He was banned from trading in the Hong Kong markets for 4 years after admitting to using inside information to trade Chinese bank stocks. Reporting shows that Huang managed up to $10 billion of the Huang family's wealth at Archegos. Archegos prime brokers allowed the firm to borrow and hold assets many multiples its total size. Since extending total return swaps to a counterparty carries credit risk with it, it seems likely that Credit Suisse and Nomura are regretting their dealings with Archegos, as they've now both been hit by heavy losses as they unwound their positions with the fund. From Reuters, Credit Suisse has yet to confirm its losses, but the sources said the Swiss bank faces losses of up to $4 billion. Nomura, Japan's largest investment bank, warned on Monday of a possible $2 billion loss. Bank stocks have taken a hit across the board this week, despite Goldman and Morgan Stanley trying to reassure the markets that they got out in time. Credit Suisse, Goldman Sachs, Morgan Stanley and Nomura all largely down in the last week. Via Interactive Brokers, what could the SEC do to improve transparency? While Archegos Capital is not a hedge fund, their use of total return swaps to avoid reporting stock trades on the Form 13F is a technique also utilized by certain hedge funds in order to avoid the disclosures. The SEC could act to address this by expanding the range of financial products disclosed by Form 13F. This would help regulators and the broader public have a better window into the activities of hedge funds. The SEC could change the reporting on Form 13F to include short stock positions, short option positions, total return swaps and other equity derivatives that mimic the behavior and payouts of stocks. Is there a role for Congress in Archegos? Another issue highlighted by the Archegos situation is the carve-out that family funds enjoy from registering under the Investment Advisors Act of 1940. The Dodd-Frank Wall Street Reform and Consumer Protection Act exempted family offices managing solely their own finances this requirement. Congress, together with the regulators, may want to examine if this exemption for family funds like Archegos are creating regulatory blind spots that contribute to systemic risk. Unicorn Head, if you appreciated this post, please consider subscribing to support the newsletter Unicorn Head. Takeaways from the second GameStop hearing in the House Financial Services Committee: from potential conflicts in payment for order flow, to risks hedge funds might present to the financial system, to whose fault was it that Robinhood halted GME trading, the second House hearing on GameStop covered a lot of ground. Alexis Goldstein. Read more posts by this author. Alexis Goldstein, the 18th of March, 2021. 10 min. Read on Wednesday, the 17th of March. I testified before the House Financial Services Committee at their second GameStop hearing. You can read my written testimony in full here, and watch the hearing here. Below are my top-line takeaways. Whose fault is it that Robinhood prevented GameStop buy orders? Probably Robinhood's. One of the themes that many Republican lawmakers hit on throughout the day was this idea that it perhaps wasn't Robinhood's fault that they, and other brokerages, prohibited purchasing GameStop stock on the 28th of January. Many Republicans seemed to echo the excuse made by Robinhood in a blog post blaming the lack of real-time settlement of trades for its trading freeze. I think this is likely a red herring. Long before Robinhood faced issues raising capital to meet clearinghouse requirements, it had a track record of outages and design failures with tragic consequences. Over the series of several days in late January and early February, Robinhood drew down at least several $100 million from its bank credit lines and then raised some $3.4 billion from investors. Bloomberg reported that Robinhood was going to use the bulk of the funds as collateral at DTCC's clearinghouse. Bloomberg's Matt Levine said that Robinhood's investors got a substantial desperation discount for their emergency investment. Separately, Robinhood is in talks with banks to raise another $1 billion of debt. In a blog post on February 2, 4 days after Robinhood halted trading in GameStop, Vlad Tenev wrote T+2 settlement exposes investors and the industry to unnecessary risk. To me, this seems like it may be an attempt to blame what may be a failure to manage Robinhood's own internal risk on industry-wide settlement standards. While there are certainly reasons to move to settle trades faster, which I discuss below, I think it's safe to assume that most broker-dealers have many employees dedicated to estimating what amount of capital they'll need to provide to their clearinghouse on any given day. Proper planning, and ensuring you have enough capital to give the clearinghouse in times of volatility, is a part of running your business. It would be helpful for the committee to ask Robinhood how many employees, including how many quants, were building and monitoring their internal capital models prior to January 2021. I suspect the number might be significantly lower than other firms. Sidebar: what's a clearinghouse? What's capital? A clearinghouse is an entity that sits between brokerages, and acts to mitigate the risk of any one individual broker failing. There's a helpful discussion of this in the committee's memo for the hearing, if you'd like to learn more. The Depository Trust and Clearing Corporation, DTCC, a member-led holding company that is responsible for clearing and settling much of U.S. stock trades, facilitates the clearing process by serving as a centralized clearinghouse for more than 50 exchanges and equity platforms, processing trillions of dollars in securities transactions daily. Because there is a 2-day period between trade date and settlement date, T+2, there is a risk that a broker may not be able to complete its end of the transaction by the settlement date. For example, the buyer fails to deliver the cash, or the seller fails to deliver the security, due to potential changes in market or financial conditions, including price fluctuations in the transacted security. To safeguard against a potential default by either the buyer or seller, the National Securities Clearing Corporation, NSCC, a subsidiary of DTCC, maintains a multi-billion-dollar clearing fund which is funded by member brokers, including Robinhood, in the event of such a failure. The clearing fund deposit amounts are calculated at least once daily pursuant to a formula, established by NSCC's rules, designed to cover the fund's exposure to a given member's risk based on the riskiness of that particular member's portfolio. That includes, among other factors, a member's concentration in volatile stocks, the volume of trades occurring, imbalances in buying and selling, and the member firm's financial condition. As a member broker's risk profile grows, the NSCC may demand that it deposit more money in the fund. This is a free post from Markets Weekly. If you appreciated it, please consider signing up here for premium access to all posts. The Democrats are concerned about potential conflicts inherent in payment for order flow. I believe it's important for regulators and lawmakers to consider how to make the true costs of trading more transparent. Payment for order flow, FOF, an arrangement where a market maker pays a retail brokerage a preset fee for every trade they execute, obscures this cost in many ways. And many Democrats asked about the potential for conflicts in FOF, beginning with Chair Maxine Waters. Payment for order flow, FOF, may obscuring the true cost customers are paying. I liken it to Facebook. If you're not paying for it, that often means that you're the product. Many years ago, Robinhood made upwards of 80% of their revenue from FOF.
I understand the allure of Robinhood. When I first learned about Robinhood, I thought it showed great promise. Ms. Goldstein, payment for order flow, which was pioneered by the fraudster Bernie Madoff, allows brokers like Robinhood to make huge profits by routing their customers' orders to market makers like Citadel, instead of sending them directly to an exchange like the New York Stock Exchange. even if it means brokers won't obtain the most favorable trading terms for investors. Can you please explain whether you think these disturbing conflicts can ever be truly mitigated in such a way that guarantee brokers and other market participants are acting in the best interest of their customers?
Chairwoman Waters, thank you for the question, and thank you for holding this hearing today. I think it's a very if we look back to 2016 in the Obama administration, the Securities and Exchange Commission wrote a memo to its Equity Market Structure Advisory Committee, and it identified a series of potential conflicts with payment for order flow. They thought it might interfere with a broker's duty to receive best execution for their customers. They thought it might create perverse incentives for them to route their orders to market makers instead of to lit exchanges. And they identified that it may, in fact, be obscuring the true cost that customers are paying for their order flow. I like to liken it to sort of Facebook, right? If you are not paying for something, that often means that you yourself are the product. And Robinhood, many years ago, made upwards of 80% of their revenue from payment for order flow. And that SEC enforcement action that you identified, they pointed out that they hid that information for their customers after the publication of the best-selling book Flash Boys made payment for order flow somewhat unpopular. They took it off of their frequently asked questions page. So I do think that the Securities and Exchange Commission should revisit all of those questions that they had previously in 2016 in the Obama administration. They should ask, should this practice be prohibited? Is it too confusing? Does it mask the true cost of the trade? Or should brokers be required to pass these payments on to their customers, which could be another way to address the problem?
Here is the 2016 memo the SEC wrote to its Equity Market Structure Advisory Committee, asking a series of questions about FOF. The Commission pointed out that FOF can create potential conflicts with a broker's duty of best execution. Best execution is a legal mandate that requires brokers get the most advantageous order execution for their customers. Brokers must conduct regular and rigorous reviews of its execution quality against competitors to evaluate if it's obtaining the best terms reasonably available for customer orders. The SEC's concerns about FOF's potential conflict with best execution now seem prescient. Robinhood has already faced regulatory enforcement actions for past failures on best execution. In December 2020, the SEC charged Robinhood with failing to disclose that it was using this payment for order flow model at all. The SEC also found that Robinhood was failing to provide best execution to its clients, thus costing them over $34 million due to inferior trade prices even when factoring in zero commission trading. FINRA fined Robinhood in 2019 for best execution violations related to its customers' equity orders and related supervisory failures. Robinhood paid a $1.25 million fine. In 2016, the SEC also noted that without FOF, market makers could have incentives to quote more competitively, leading to better prices for their customers. The SEC suggested that if FOF were prohibited, market makers might need to lean harder on the competitiveness of their quotes in order to gain the business of brokers. Ending FOF would not necessarily end commission-free trading. By contrast, many Republicans in the hearing either brushed off concerns about FOF, or implied in that it would also end zero commissions. But as I mentioned in my written testimony, there are brokerages like Public who ended FOF in February, but still offer commission-free stock trades. And Fidelity doesn't use FOF for its stock trades, and also offers commission-free stock trades. Robinhood has simultaneously argued that the FOF amounts are low, an average of $0.0023 per equity share. If that's the case, it seems reasonable to expect that, should Robinhood's revenue stream of FOF end, the commissions it charges to clients would also be in the $0.0023 per equity share range. Yes, in the past, most discount brokerages used a flat fee model, with a price per order rather than a price per share executed. But there's no reason they couldn't use a price per share commission model if that's what potential customers were interested in seeing. Republicans seemed excited to give the SEC lots of enforcement work. Typically, Republicans are more skeptical of the Securities and Exchange Commission, SEC, doing, well, much. But throughout the hearing, they kept asking former SEC Commissioner Michael P. Wauer things like, isn't the SEC already enforcing best execution obligations for brokers, and highlighting the other ways that the SEC already has authority to look for wrongdoing. Which is of course true. What's interesting is how hard Republicans seem to want to lean on the SEC, when historically at least, they have been in favor of cutting the SEC's budget, or at least opposing the budget increases the SEC has requested. So I hope, but don't expect, that this is a new era where they will support a well-funded SEC. Democrats are interested in bringing more transparency to short-selling Republic. Nydia Velázquez pointed out that while large investors like hedge funds must disclose certain long positions, no such disclosure is required for short positions. This means the public doesn't know what amount of stock hedge funds are shorting, it's not disclosed on the Form 13F hedge funds have to file. The reason we knew that Melvin Capital was short GameStop is because they were short put using put options, and options are disclosed on Form 13F. To address this, the SEC could move to implement a piece of the Dodd-Frank law that was never implemented. Section 929X required the SEC to write rules to ensure there is monthly, public disclosure of short sales. In 2015, the NYSE petitioned the SEC for them to implement this rule. But it remains unfinished. Many lawmakers see certain hedge funds as a potential systemic risk. Multiple lawmakers, including Reps Al Green and Jesus Chuy Garcia, asked about the potential risks to the financial system that hedge funds might be creating. This was discussed at length in the committee's hearing memo. The market dominance of some capital market participants raises concerns about systemic risk and, in particular, correlated risks arising from the relationship between financial institutions. For example, Citadel LLC is a multi-service hedge fund and financial services company, and its subsidiary, Citadel Securities LLC, is one of the largest market makers and, according to its website, executes approximately 47% of all U.S. listed retail volume. Citadel Securities also, reportedly, handles almost as much trading volume as Nasdaq. Further, Citadel Securities along with market maker Virtu Financial, account for more of the overall equity market than the New York Stock Exchange. With respect to Citadel, some have raised concerns about a single market maker managing such a large volume of retail order flow, and what that means in terms of pricing. Others have questioned whether Citadel has such dominance in our financial markets that it poses a systemic risk to the entire U.S. financial system. One quick win for transparency into the sorts of risks that hedge funds might present to the financial system would be for Treasury Secretary Yellen to restart the hedge fund working group at the Financial Stability Oversight Council. There used to be a hedge fund working group at the Financial Stability Oversight Council. Before they created it, they noted no single regulator had all the info they needed to look at a complete risk profile of hedge funds. It was shut down under Trump.
For that, Ms. Goldstein, in your testimony, you mentioned that GameStop incident revealed more than just volatile stock prices. You mentioned that the rise of retail trading and the dominance of certain hedge funds like Citadel could threaten the stability of our financial system. What do you think that regulators such as FSOC should do to keep the volatility that we saw in January from infecting our whole financial system? And what can Congress do to help our regulators do their job?
Thank you for the question, Congressman Garcia. I think there used to be a hedge fund working group at the FSOC that was shut down under the Trump administration. And before they created it, one of the things that they noted in a report was that there was no single regulator that had all the information that they needed to look at a complete risk profile of hedge funds. And so I think an easy thing for Secretary Yellen to do would be to restart the hedge fund working group to look at risk to the system that hedge funds possibly contribute. I also think that Citadel Securities is a particular thing that they should look at closely.
Should we push to settle trades faster than 1 day, T+1? Another question asked repeatedly by many Republican lawmakers in the hearing was about the potential move to settle trades either same day, T+0, or instantaneously, real-time settlement. A couple of lawmakers even mentioned, you guessed it, blockchain. One funny exchange happened when former SEC Commissioner Piwauer noted that a lot of people ask him about blockchain and real-time settlement, and when he tries to respond, they just respond by saying blockchain louder. I discussed one operational difficulty with moving to settle trades faster than T+1 in response to a question from Representative Van Taylor. Appreciated this question and discussion today with Rep Van Taylor on netting, and why moving to settle trades faster than 1 day, T+1, is going to have a lot of operational costs.
You had the most important and sort of the deepest thoughts on this particular topic, and I know we've talked a lot about it, but, and I'm just going to read what you wrote. You wrote, losing the benefit of netting would create significant new operational costs. Could you expand on that?
Sure, Constance. Thank you for the question. So if you execute a very large trade, say you trade 1 million shares and perhaps you send it to some algorithm that tries to break it up into chunks, you might have many, many transactions across the 1 million shares you're trying to trade. And if we lose the ability to net those transactions, operationally, we are going to have to look at every single one of those executions instead of being able to combine them together. And so I think that this is one of the main challenges to moving to what people call real-time settlement, which would be even faster than T+0, right? I think there's T+0 and then there's real-time. I just don't know that the industry is prepared to do that just yet. And I think that's why you hear most folks, I think there's perhaps some consensus about T+1 and some hesitation about anything quicker than that.
I also elaborated on this question in my written testimony. While there are many reasons to consider moving to T+1 settlement, challenges remain that make moving to T+0, or even real-time settlement, difficult at this time. As one example, T+0 would eliminate flexibility some market participants rely on, and prohibit netting, which allows transactions to be netted together even if the trades execute over tens, or hundreds, or thousands of separate orders. As the Depository Trust and Clearing Corporation, DTCC, wrote, allowing trades to net settle reduces the total amount of cash and securities that have to go back and forth throughout the day, and eliminates a significant amount of operational and market risk. Losing the benefit of netting would create significant new operational costs. Rather than pushing to move to T+0 or real-time settlement before the industry has even made it to T+1, Congress and the regulators should instead examine if broker capital standards as they are today are adequate to withstand periods of extreme market stress. Data gaps and public blind spots. Another question I have is, what was the over-the-counter options trading activity in GameStop on the most volatile days? While some of this information is likely available through expensive, proprietary data tools like the Bloomberg Terminal, this isn't information easy for the general public to access. From my written testimony, major Wall Street institutions may choose to trade equity options over the counter, when large broker-dealers trade bespoke options with each other, instead of through the standardized options available on exchanges. But Wall Street firms typically still hedge their positions by buying or selling listed stock. Hedging is a way to minimize the risk of large losses by trading an offsetting position. While doing so limits profits, it also limits losses. When trading options, many Wall Street flow trading desks employ a technique known as delta hedging, where options traders try to insulate their portfolio's value from moves up or down in the price of the stock. They do so by purchasing or selling stock against the options they trade. Having a sense of the volume of over-the-counter options trades in meme stocks like GameStop, Nokia, BlackBerry, COS, and AMC from the 21st of January, 2021, the 4th of February, 2021 would provide a bit of a window into the role large institutions played in GameStop's volatile run-up and down in price. Thus, regulators should examine the trading volumes that institutional players made in over-the-counter equity options markets and dark pools, which are venues unavailable to retail traders, during the period of extreme volatility in GameStop trading. In addition, lawmakers should evaluate if there are data gaps or points of friction in current reporting regimes, and if so, work to bring more transparency and speed of reporting to over-the-counter options. The SEC should also work to finalize the consolidated audit trail, first proposed after the 2010 flash crash, where in just 10 minutes, the Dow Jones Industrial Average Index lost 1,000 points, nearly 9% of its value, only to recover shortly thereafter, and now long delayed. The big picture in my opt for the NY Times, I tried to put GameStop in a larger perspective. Yes, many retail traders have done extremely well this year. Others have unfortunately likely bought at the top of GME, and realized some losses since. While apps like Robinhood proclaim they want to democratize finance, I think a better solution is to rebalance our economy so no one is left behind, especially not during a pandemic. Instead of creating policies that benefit the wealthy, or large corporations, we could guarantee shelter, provide baby bonds, make higher education free, and cancel existing student debt, which President Biden has the authority to do without needing Congress. Or, we can all try and chase the latest gold rush play. Sometimes it works. But I think there are less risky ways to organize our society, and I think it's worth pursuing public policy that lifts up everyone. Thank you to @Rep Pressel, @Rep Maxine Waters, @Rep Adams, @Ilhan, @Rep Mundere and all co-sponsors of the resolution urging @POTUS to cancel student debt to democratize our economy. We need to provide everyone enough so we don't have to chase gold rush schemes.
Ms. Goldstein, Robinhood proposes that turning everyday Americans into day traders is democratizing finance, but you've written that the real solution to breaking the power of finance is to rebalance the recession-wrecked economy. What does democratizing the economy really look like?
Congresswoman, I think it means that we need to rebalance our economy so that everybody isn't struggling or looking for the next gold rush scheme in order to pay their rent if they're facing eviction. I mean, I think you've been a real leader in this space, and so has the chairwoman, and so has Representative Adams and many others who have called on the president to cancel student debt through executive authority. I think there are a lot of different ways that we can tackle this problem. But I think one thing that we should think about, and you all as policymakers can think about, there's no way to save for retirement right now that doesn't give a cut to Wall Street. Unless you buy a savings bond or unless you are rich enough to purchase a municipal bond, we always have to give a cut to Wall Street if we want to save for our future. And 47% of Americans have no exposure whatsoever to the stock market. And so they're not going to be able to use Robinhood to try and, make some wealth for themselves. And I think we need to come up with other solutions in order to figure out how we can build wealth. And there are a lot of potential solutions for that. The American Rescue Plan is a part of it, but I think we need to do much more. And I thank you for your leadership on the resolution on canceling student debt.
What happened with GameStop? GameStop madness isn't David vs. Goliath. It's Goliath versus Goliath, with David as a fig leaf. Alexis Goldstein. Read more posts by this author. Alexis Goldstein, the 28th of January, 2021. 11 min. Read It's not David vs Goliath. It's Goliath versus Goliath, with David as a fig leaf. This is a free post from Markets Weekly, a newsletter by former Wall Street professional Alexis Goldstein. If you appreciated this post, please consider signing up here for premium access to all posts. In early January, GameStop was trading around $18. By close today, it had reached $364.15. An intense buzz has formed in the stock thanks to discussion on the Reddit forum Wall Street Bets, further enhanced by dominant coverage in the media. At least one hedge fund, Melvin Capital, that was shorting GameStop, betting the price would fall, got utterly crushed. Some cheered the victory of Reddit and Robinhood over Wall Street. But it isn't so simple. If you'd like to skip the explanation and jump to my suggestions for the future, go here. This mania started when a popular Reddit forum called Wall Street Bets began writing about some of the most shorted retail stocks. Sidebar: what is shorting? You can bet that the price of a stock will fall by taking on a short position. This requires you to borrow the stock from someone else first. Your broker then immediately sells the stock. Since you think the price will fall further, you're calm, cool, and collected. You wait to the price to fall more, and then you buy the stock back at a lower price, so you can return the shares to whoever you borrowed it from. Wall Street Bets publicly hatched a plan on the forum to buy and hold GameStop stock, and GameStop call options, in order to drive the price up so high, it would create a short squeeze. A short squeeze is when a price jumps so high that the short sellers are forced to buy back the stock to close out their position, usually due to their broker requiring them to put up more cash because they're losing money so fast. This is a margin call. All the attention and momentum from the press brought in more retail traders buying GameStop, and Wall Street itself hopped in for the ride. So many people buying call options also caused the people selling the Robinhood crowd those options to buy the stock in order to hedge their bets. Sidebar: explain options to me. One of the byproducts of both Robinhood and Wall Street Bets has been the popularization of trading options by retail traders. A stock option is a derivative that gives you the right to buy or sell 100 shares of stock in the future at a set price. The price you have the right to buy or sell it at is the strike price. The option has an expiration date. It also can be either a call option, which gives you the right to buy the stock, or a put option, which gives you the right to sell it. When you buy a call option from a market maker, if that market maker doesn't already own the stock, they have to hedge their bet by buying the stock. So not only did you have all of these people on Robinhood buying GameStop stock, many were also buying GameStop call options. That meant the market makers on Wall Street were also buying GameStop stock in order to hedge their position. It's worth noting that since the start of the pandemic, there's actually been a monumental increase in retail traders buying call options. All of this drove the price of GameStop into the stratosphere. We know that many Robinhood and Redditors are profiting off this. But they aren't the only ones. Citadel pays for order flow from Robinhood. Citadel is a massive hedge fund, founded by billionaire Ken Griffin, with 3 different firms, a tech firm, an asset manager, and a market maker. The market maker, Citadel Securities, pays Robinhood a preset fee for every trade they execute. It's worth noting that Citadel isn't just any market maker. They're massive, handling almost a quarter of all listed, aka exchange-traded, stock options. This is what's called a payment for order flow, FOF, arrangement. Market makers can profit from these arrangements in a few different ways. Read more here if you want the full details. But the best way to summarize it is this: Citadel can batch the Robinhood orders together, leverage its sophisticated high-frequency trading, HFT, algorithms to front-run, buy shares in front of or before your client does, Robinhood trades. Robinhood traders are generally not buying or selling options in lots, batches of 100, they are usually buying 1 or 2 or 10 options at a time. So Citadel may batch a number of Robinhood users' options together, buy multiple lots themselves from another dealer, then fill the batch of Robinhood orders at a slightly worse price than what Citadel paid for it. Image via Centerpoint Securities. Historically, there's been debate about whether or not payment for order flow should even be allowed. The practice was actually originated by none other than Bernie Madoff, the famous Ponzi scheme fraudster, in the 1980s. During the Obama administration, the SEC asked one of its market advisory committees if payment for order flow should be banned. Citadel has also gotten into trouble with the SEC in the past for the way it handled its payment for order flow. In 2017, they fined Citadel Securities $22.6 million, saying the firm inaccurately described how it handled trades placed by small investors, according to Bloomberg. Some, like Institutional Investor magazine, a major Wall Street trade publication, have asked, essentially, who cares? They noted in June 2020 that payment for order flow is nothing new and that the practice is used by Fidelity, E** Trade, Charles Schwab, and TD Ameritrade, among others, SEC Rule 606 disclosures show. But unlike the other firms that use this technique, Robinhood doesn't publish data on how much price improvement it gives customers. Not only that, but Robinhood wasn't initially honest about this arrangement. In December 2020, the SEC charged Robinhood with failing to disclose that it was using this payment for order flow model at all. The SEC also found that Robinhood was failing to provide best execution to its clients, thus costing them over $34 million due to inferior trade prices even when you factored in zero commissions. Even FINRA, Wall Street's self-regulating overseer, also fined Robinhood in 2019 for best execution violations related to its customers' equity orders and related supervisory failures. Robinhood paid a $1.25 million fine, but did not admit or deny any wrongdoing. Sidebar: what is best execution? Robinhood is a broker, and as such, is obligated to provide its clients with best execution on their trade. This means the broker must put their clients' interests first, and try and get either the best price or fastest execution, and not send their orders to the market maker paying them the best price for order flow. Citadel is the dominant market maker used by Robinhood. Citadel is not the only market maker that Robinhood uses, but it's the largest one. It accounts for the majority of its stock executions, and more than 55% of its equity option executions. As of July 2020, Robinhood Securities SEC Rule 606 and 607 disclosure, July 2020 sidebar: what's a market maker? Market makers are the people who sit as intermediaries between buyers and sellers. When you want to buy, they're there to sell to you. When you want to sell, they stand ready to buy. They make money off of the flow and they carefully hedge all the positions they take on in order to manage the risk of their portfolio. Robinhood, Citadel, Melvin Capital, and Point72. So Citadel is a hedge fund whose market-making arm is handling the majority of Robinhood orders. Meanwhile, another hedge fund, Melvin Capital, was one of the funds caught in the GameStop short squeeze. This week, they finally had enough, and had to close out their short position for a big loss. Who stepped in to buy up a piece of Melvin Capital after that happened? None other than Citadel Securities' parent, Citadel LLC. The WSJ reported on Monday, Citadel LLC and Point72 Asset Management are investing $2.75 billion in hedge fund Melvin Capital Management, an emergency influx of cash that is expected to stabilize what has been one of the top-performing funds on Wall Street. Who's the other party that gave cash to Melvin Capital? Point72, the new investment advisory firm for Steve Cohen. Cohen's former hedge fund SAC Capital, the firm that pled guilty to insider trading in 2013, though Cohen himself emerged without admitting guilt. It's also worth noting that Melvin Capital is run by Gabriel Plotke, who was one of SAC Capital's top traders. Cam Carson has some further thoughts on the Citadel /Point72 rescue of Melvin here. Wall Street loves data. It's important to remember that Wall Street is a data machine. Wall Street will use data from every avenue it can to try to make predictions about what is going to happen next in the market. They hoover up data to feed their models, in order to make valuation decisions, and in order to arrive at what is the best, most accurate price of something. I remember one of the traders that I used to work with used to pull up every lot of different news sources, including the Drudge Report, which I thought was ridiculous. But he said, "Look, I want to get news from every place I can, and I want to understand what people from all different kinds of points of view are thinking." Traders seek information and rumors and tips like heat-seeking missiles. Usually, traders use expensive vendors to supply them with quotes to feed into their models. Some of those quotes come from financial intermediaries, called interdealer brokers, whose only purpose in life is to mask the orders of the big banks, so they can trade with each other with some degree of anonymity. I learned in my time on Wall Street that with enough pressure, some interdealer brokers would admit who was on the other side of the trade. Wall Street loves data, but they also loathe other people finding out their data and their order flow. That's what's contributed to the rise of dark pools, private exchanges that allow big, institutional investors to send very large trades without impacting the market overall. One question I have about the GameStop situation is, how much order flow for GameStop flowed into dark pools, both during and after market hours? Why do I mention this? Wall Street usually works very hard to find out what their competitors are doing. With Wall Street bets, they don't have to work hard at all. It's all being done in the open. So all of these traders on Wall Street know the trading plan of thousands of retail traders. Meanwhile, Citadel, thanks to the payment for order flow arrangement, has even more data than that. So the question becomes, is this really Robinhood sticking it to Wall Street? And the answer is, no. This isn't hedge funds versus retail. It's hedge funds versus other hedge funds, and versus Wall Street flow desks, which make money every day, and excel at doing so on volatile days, with retail driving the way forward. Melville Capital may have imploded, but Citadel took part of it over. That's hardly a resounding victory over the biggest titans of finance. Trump deregulation and market chaos. It's important to remember that the market chaos we have seen from all of this isn't just about a Reddit forum, a slick app, or media buzz. It's also, in some ways, yet another form of Trump-era chaos. Trump oversaw a massive wave of financial deregulation. Here are just a few examples. The Trump administration shut down a working group that was examining the risks that hedge funds might pose to the financial system. This working group was housed at the Financial Stability Oversight Council. Treasury Secretary Steve Mnuchin shut it down. Trump put a former executive from the cryptocurrency exchange Coinbase in charge of one of the major banking regulators, the Office of the Comptroller of the Currency, OCC. He proceeded to deregulate crypto at banks. As Yahoo Finance detailed, during his term, the OCC published several interpretive letters or made statements announcing that banks can provide services to issuers of stable coins, partner with crypto custodians, conduct payments using stable coins, and operate nodes on blockchain networks. Trump appointed former One West executive Steven Mnuchin, who oversaw massive foreclosures during his tenure, to the Treasury. Trump also appointed a former white shoe law firm attorney Jay Clayton, who defended many Wall Street clients, to run the Securities and Exchange Commission, SEC, which oversees much of the stock and equity options marketplace. Did the Fed overheat the market? Federal Reserve Chairman Jerome Powell was asked about the GameStop price move on January 27 and whether the Fed's massive intervention in the corporate bond markets were creating asset bubbles. Chair Powell said, "I think the connection between low interest rates and asset values is probably something that's not as tight as people think because a lot of different factors are driving asset prices at any given time. But it's undeniable that the Fed's actions in the corporate bond market last spring brought down credit spreads substantially. This led to lower yields across the